Lululemon stock has just fallen about 30% since its all-time high. Today we're going to be finding out if it's at a fair value now, where it could be headed from here, and what it's currently worth. But for now, we're going to look over some of the fundamentals and see how the business is doing, how it's performing, and why it may have dropped 30%. So we have price per share of $357.03, a price to earnings ratio of 29.53, a market cap of 45.4 billion, and an enterprise value of 44.13 billion. The company has a cash debt ratio of 1.6, so for every dollar of debt they have $1.60 to pay down their debts and expand their business. Looking at their profitability, we see pretty solid green bars versus the industry as well as versus their historical performance. So for their gross margins, they're currently at the highest they've achieved in the last 10 years with 58.31. With operating margins, again, the highest in the last 10 years with 22.95. Netting, just under their maximum in the last 10 years with 6.12 and a maximum of 6.22. And for free cash flow, they're achieving the highest free cash flows in the last 10 years with 17.09. So to me, these margins actually look really great. It does surprise me that the stock would have fallen 30% with margins like this, because these are the best numbers they've had in the last 10 years. So I use these four margins to tell me something about the business's performance. But for management, I use ROE, ROA, ROIC, and ROC. And for these, we see as well that versus the industry, they're performing very well. And it looks like they're all above 20, so I have no complaints there. Strong margins, strong returns for ROE, ROA, ROIC, and ROC. When it comes to the price to earnings, they have a current of 29.53, and it looks like their median is 40 in the last 10 years with a minimum of 21.87. So sitting between their minimum and median for price to earnings. So that tells me maybe not a bad spot to be buying in if you're going to hold this for the long term. They have a trailing 12-month revenue of $9.6 billion, and they net 16% of that. Looking at their revenue and financials on a trailing 12-month basis, we can see that revenues are steadily increasing over time, so great sign there. And we also see that net income is growing alongside it as well. It did slow down a little bit here, although it's back again at 1.5 billion. We can see that their cash debt ratio is fairly steady alongside their debt, at least recently, and then all of a sudden jumps way up here in the most recent quarter. So that's a good sign. They have more cash than they have debt. No complaints. And on a share buyback trend here, so they are buying back shares, which increases shareholder value by decreasing the share float. We can see that by business segment, most of their products are in women's, with 63.9% in women's products, 23.4% in men's, and 12.7% in other categories. The business is mostly selling in the United States, with 66% of their revenues coming from the United States, 13.4% from Canada, 10% from China's mainland, 8.9% in other areas, and 1.8% in Hong Kong, Taiwan, and Macau. But to see what's currently priced in, let's run a DCF. Before we do that, if you do enjoy these videos, please leave a like because it helps. Subscribe so that you can find these businesses in the future and see these valuations. And leave a comment if you have any questions, or if you disagree with anything in the video, let me know in the comments so I can improve it in the future. So in the DCF, we have 4-star business predictability, so a fairly predictable business. Looking at free cash flow, we have data for the 10-year average, 5-year average, and 3-year average, as well as for earnings per share. And they're all fairly strong looking numbers, just about 20 or higher for each of them. So looking at free cash flow and seeing what's currently priced in, there's about 17% growth for the next 10 years priced in for free cash flow. And we see that over the last 10 years, they've achieved 22.6%, 5-year of 19%, and a 3-year of 43%. So growing fairly strongly in the 3-year average, 5 years just about 19 to 20, and a 10-year of 22. So If they are to continue for the next 10 years growing what they have for the last 10, then we have a fair value of 511, whereas currently we're at 357. And on a bearish estimate, if they were to slow down to, let's say, maybe 15, then a fair value would be closer to 317, whereas currently we're at 357. Looking at earnings per share and seeing what's currently priced in, there's about 17% growth for the next 10 years priced in for earnings per share. And we see that over the last 10, 5, and 3 years, they've achieved significantly higher than that 17. So if you believe they can grow at 20, there's a fair value of 434. If you believe they'll grow higher, maybe even closer to 25, then 609 would be a fair value. And on a bearish estimate, if you think they'll achieve 15 for the next 10, then we have a fair value of 308. And if you think they'll really slow down to 10, then we could see 220. But that is just fair value. Stocks can trade way higher, way lower. It all depends on sentiment around the business, and that's just fair value. Things can trade for a premium or a discount. It all depends. And very frequently stocks do trade for premiums. Many stocks in the market right now are trading for a premium, such as Costco, but it all depends on the moat of the business. I do consider Lululemon to be one of the best athletic wear products. It's sort of like one of those companies that defines the market, and it created the athletic wear, athleisure market. So to me, I think it looks like it's about fair value right now, maybe even a little bit cheap. But that being said, this is my take on Lululemon stock. Again, if you enjoyed the video, please leave a like, subscribe to the channel, and I'll see you next time.